Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mark Marex, Senior Specialist with Index Research and Development at Nasdaq Investment Intelligence, to discuss Nasdaq-100 performance in a week that we saw extreme moves. We're also going to take a look at the lopsided valuation story. Of course, everybody thinking about valuations and potentially when the bottom is in to pick up some of these deals here. Mark, if we take a look at your first chart, put this into context of year-to-date performance and how that's matching up with what's been a pretty volatile week.
Sure, Jill. Yeah, some of the daily moves have been really shocking considering that most people think we're still nowhere near heading into a recession. But outside of that, what I wanted to show here is just kind of bring everyone up to date. These are the top 7 names in the Nasdaq-100, approximately 50% of the index weight versus overall index performance. That's that one dashed black line. You can see we have officially re-entered a bear market just barely after yesterday's big drop, down about 21% year to date. You can see about half these names are slightly outperforming. Apple is the relative big outperformer here, down just under 12% year to date. And you can see Facebook is still the worst. Of course, Facebook kind of jump-started a lot of this angst within tech in particular with its earnings report in January. Their earnings were actually quite a bit better in 2Q, or sorry, when they reported in April for 1Q. And you could see there was a bit of a pop in Facebook or Meta stock in April, but still down 38% for the year. You could see a couple other names, Amazon and Nvidia, namely, are also breaching that 30% year-to-date drop threshold. So what we had, I think, over the past year or so, when the market for really speculative things peaked kind of in February of last year, is that a lot of the smaller names in the Nasdaq-100 were getting pressure. They were very, very high valuation names, talking about over 100 PEs. You'll see on the next slide, the vast majority of the index has normalized, but at the same time, that normalization has really kind of spread into some of these larger names and potentially even overdone it.
Yeah, Mark, I'm taking a look at your next slide here, kind of jumping the gun here, but Micron, wow, there are a couple of decent deals in the index right now.
Yeah, I would say there's a number of decent deals. This chart is showing you all the names in the index that are forecasted to grow their EPS over the next year in full year 2023 versus this year, as well as anything that is under a 40 PE forward-looking basis. So that's 94 names in the index of 100. So I would say, based on this, we got to about a 40 PE on a trailing basis for the Nasdaq-100 at the peak of the sort of pandemic ramp that we saw in late 2020. So really most of the index has normalized to what I would say is pretty reasonable valuations. And what I've highlighted here is kind of some of the inherent irrationality that I think that's happening in the market in the opposite direction, right? Market tends to overdo things on the way up sometimes, also applies on the downside. And what I've highlighted here, Nasdaq-100 isn't known for names like Costco, Pepsi, Keurig, Dr. Pepper, Kraft Heinz, but there are a handful of those types of names in this index. And you can see that, pretty much in every single case that I've highlighted like that, you take your eyes up above and you can see a company that is growing at a much faster rate, that is in more of those traditional NASDAQ sectors, that is valued at the same PE ratio. So Kraft Heinz is just above a 15 forward-looking PE, growing at under 5% a year earnings. Facebook and Google are right around the same place, growing earnings at 20% a year. So what you've seen is, a lot of these names get really beat up. I get it. Rates have gone up. High growth names got to get adjusted valuation on the downside because future cash flows are all of a sudden worth less. But the fundamental underlying story of a lot of these names' growth trajectories and profitability trajectories is unchanged. Funny enough, I would say Netflix is the one on here where the story really has changed because we've seen that subscriber growth kind of shut off. And guess what? Netflix is at a PE of 15. That seems pretty fairly valued to me, considering they're still growing earnings 10% a year.
Yeah, that is a great chart. It's probably one of my favorite charts that you shared with us. And Mark, in the last minute or so here, let's wrap up and take a look with what's happening with rates and fixed income.
Yeah, really simple story, more of the same. The last time we looked at this a couple of weeks ago, my axis on the left side topped out at 3% for all the various US Treasury yields here. I had to move it up to 4% because a number of these crossed up over 3 recently. Seems like they're definitely going to be on their way to 4 as the Fed kind of tries to get in front of the market and figure out what's a neutral rate of interest. That's creating, a lot of pain on the bond trade, which is something you don't usually see when stocks are under pressure. So the fact that a lot of fund managers are unable to kind of offset some of their equity losses with fixed income gains this year, I think is just adding to the volatility, and is frankly adding to some of that overdone downside on the equity side as people have to liquidate and raise cash and things like that. So definitely important to keep an eye on what's happening with these rates, what's happening in the bond market as well.
All right. Great insight as always, Mark. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.